The video I'm going to do today is on some cash flow statement activities. Right, the first question gives you some information, and the first thing we're required to do is calculate the net income before tax by preparing an appropriation account. The amount that they're actually asking you to calculate here is this one, the amount of profit that would have been worked out in your profit and loss account. So we start off by filling in our expenses that go in the appropriation account, which is our tax for the year, 41,500, and our total dividends for the year of 52,000. If you look at retained income, it's increased from 2,000 to 9,000, which means the retained income for the current year is 7,000. It would be credited in the retained income account, and when you added it to the 2,000, you would get to that 9,000. Now to calculate this figure is simple. You add up your expense side, you take the total across, and that is the amount of net profit that you've made, and it's before tax, because we're only subtracting tax after we calculated that amount there. Right, question 2. Explain why net income before tax is adjusted for interest. Interest was deducted in the income statement. We're going to add it back because it's a financing cost rather than an operating cost. We then move on to depreciation. Depreciation in your income statement was subtracted to get to net profit, but did not involve any money leaving the company. So that is why it is going to be added back, because it is a non-cash expense. The next question asks the amount that would appear in the cash flow for interest paid. Alright, in terms of interest that you're going to pay, you must look and see if you've got any expense accrued for interest, which you do have. So the first thing we're going to pay is that 2,800. The interest on loan in the income statement is the interest that you should have paid, but of that we still owe 6,900. So in other words, we take the amount that we owed at the beginning of the year, we add what we should have paid, but of what we should have paid we subtract what we still owe, and that will give us the amount that we've actually paid of 15,300 Rand. And then, assuming that 20,000 Rand of the loan was repaid, calculate the value of the new loan. If you look back up here, your non-current liabilities went from 85,000 to 97,000. So we started with 85,000. That 20,000 repayment would decrease your loan balance, and we add something, which is our new loan, X, and that must give us the non-current liabilities at the end, and you solve for X. As you are receiving money from the bank, that is an inflow of cash. Right, question 2. Here we're required to do the working capital changes in your cash flow statement. Right, starting with your inventories. Inventories here have gone from 96,000 to 92,000, so they have decreased. If they decrease, it means we've sold more, therefore it is an inflow of cash. When you move to your receivables and payables, this is very important. You must exclude SARS and shareholders for dividends, and if expenses accrued was interest, you would exclude that as well. In this case, they don't state that expense accrued is interest, so it could be for anything else. So going back to this then, if we're looking at our receivables, the two figures that are relevant here are going to be your debtors and your income accrued. So debtors have actually gone down. You take those two numbers and add them and subtract what they are. Because debtors have gone down, that means you are receiving money because they're paying you back. So that is an inflow of cash. Then in terms of your payables, in this case you've got three amounts that are relevant: trade creditors, expense accrued, and deferred income. If you add up those amounts, you will see that payables have actually decreased as well. If payables have decreased, it means you have paid back, which is an outflow of cash. Remember, if they don't state expense accrued for interest, then include it in your calculations. Right, then calculate the amount that would appear in the cash flow statement for income tax by doing the relevant note. Okay, now we need to look and see SARS whether it's debit or credit here because that's going to have an effect. So at the beginning of the year, SARS was a credit balance. That means we owe SARS money, and that is going to be the first thing we pay, which is an outflow. They tell you that the income statement amount is 31,700. That goes in brackets. That is the amount that we should have paid. If you have a look at here though, SARS ends up with a debit balance. That means we've paid what we should have paid and we've paid more. So that one is also going to go in brackets. So you paid from last year and you paid more than you should have paid this year. If you add 31,700 and 5,200, that would give you your provisional tax payment. And this one is obviously last year's tax. Right, and then explain why the amount's different in the income statement. The income statement, remember the income statement there's matching. So because there's matching, the income tax in the income statement will only be your tax expense for the current year. Whereas your cash flow statement, where there's no matching, you're recording the amount that you actually paid during the year, which included some from last year. Right, and then calculate the amount to be recorded in the cash flow statement for dividends. With dividends, you start with the shareholders for dividends. So last year we owed the shareholders 24,000. That's last year's final dividend. Your dividend expense for the year is your total dividend of 40,000. And of that 40,000, we still owe the shareholders 18,000. So the first thing we pay then is the 24,000. That was the dividend from last year. We add what we should have paid for dividends, the total, and we subtract this year's final dividend because we haven't paid it yet. And that gives you 46,000. You are paying money for dividends, so it's an outflow of cash. Right, then the next one asks you to calculate the value of premises purchased showing workings. Remember I told you about the importance of showing all your workings for fixed assets. Alright, so we start with the book value or the carrying value. At the beginning of the year was 187,500. We purchased 30,000 vehicles, so that gets added. Equipment costing 60,000, depreciated by 12,000, was sold at book value. The difference between those two numbers, 48,000, is your carrying value. You are selling, so it goes down. Your depreciation for the expense for the year is 32,000, so that also decreases your carrying value. And then you add X, which is going to be the value of the premises, and that gives you 224,200, which was your fixed assets here at the end of the year, and you sold for X. Right, then complete the sentence. The purchase of premises represents an outflow of cash, whilst the sale of equipment represents an inflow. If you buy, you are paying its outflow. If you sell, you are receiving its inflow. Right, then the next one just asks you to classify whether they are operating, investing, or financing activities. Sale of shares, anything to do with shares is where you get your capital from. That is financing. Sale of stock is day to day, that's operating. Sale of motor vehicle, you are selling a fixed asset, that's investing. And payment of creditors is another day to day, which is operating. Right, and then you need to calculate the change in cash here. At the beginning of the year, we had cash float, we had petty cash, and a favorable bank balance here. So all those numbers get added to give you 6,200. If you look at the end of the year, we started with cash floats, we had petty cash, but bank was unfavorable, which means we're going to subtract those. So if you take your difference in cash now, We've gone from positive down to negative, so cash has decreased by 8,700. Okay, that was just a few short questions on cash flow statement activities. Thank you.